Hi guys. So as you already know, stocks recently hit all-time highs, right? But now the momentum is fading and what we're seeing currently are signals of fatigue. The market is pulling back and fear is starting to rise. As you can see, the fear and greed index coming down to 50 from its previous 62. Prices are dropping really fast. But guess what? What if I told you you could turn that red into green? And that's exactly when these powerful ETFs come into play. And these ETFs move a moderately large amount in volume every day. Like I'll always tell you, pullback season is not a time for you to panic. Rather, it's a time for you to position smartly. And so in this video, I'll show you 5 powerful ETFs that go up when the market goes down, and how you can use them to protect your portfolio and even profit from pullbacks, okay? So stay with me. If this is your first time here, you're most welcome. My name is Rikia, your trading and investing coach. And on this channel, I teach you how to build wealth and gain financial freedom through trading and investing in the financial markets. So if you know you want to learn more trading tips, strategies, and get weekly market insights, then you can hit that subscribe button and turn on the notification to get notified anytime I upload a new video, so you don't miss out on any new updates or videos that I post. And you can also give a thumbs up to like and share and help this video get at least 1000 likes. So without further ado, let's dive in. First of all, let me explain this so you guys will understand better. So after the market has experienced months of bullish momentum, buyers are beginning to run out of steam. And you know, buyers are responsible for driving the prices up. So now we're now seeing lower highs and pullbacks in major stocks and sectors, most especially in the tech and semiconductor sectors. Now, here's the strategy. So instead of panicking, what do smart traders do? They turn to ETFs that go up when the market goes down. These ETFs are popularly known as inverse ETFs or volatility ETFs. Inverse ETFs are designed to move in the opposite direction of the market or a specific stock or index. Some even use leverage, maybe 2 or 3 times the daily move, to increase the returns and the risks as well. And volatility ETFs, on the other hand, spike when market fear increases. They are best used when you have a short-term strategy and not long-term holds. However, they are very powerful tools when used in the right way. Now, let's take a look at these 5 powerful ETFs. The first one we are starting with is SOXS. SOXS is a 3 times inverse ETF that targets semiconductor stocks. This means that this ETF moves 3 times as much as a basket of semiconductor stocks, but in the opposite direction. So if semiconductor stocks move up 1%, SOXS moves up 3%. So think about semiconductor stocks like Nvidia, AMD, TSMC, that's Taiwan Semiconductor. You know, the big tech chip companies. So when the price of these semiconductor stocks fall, SOXS shoots up, and it shoots up really big. And with the tech companies recently being overbought, this ETF gives you exposure to a potential correction, okay? So you should use this ETF when you see weakness in tech sector companies or after an overbought rally, okay? And SOX is ultra leveraged, which means that it gives fast gains, but it also drops very fast. It is a high risk reward. It is a high risk, high reward ETF. So you have to be ready to move quickly and use it with very strict stop loss rules, okay? And apart from that, SOXS has large daily movements and extremely large volume. Its daily average volume within 30 days is 163 million, and its average daily movement is 6%. That is moving between its daily lows and daily highs without any gaps. Okay, now let's go to the chart and see how it has performed recently. And you can see it was at an all-time high of $55 in April. And this was when Nvidia, AMD, and the likes were hitting their all-time lows. And SOXS price has been falling when they were making their all-time highs. And now you can see it's starting to move upwards and heading back to the 15s and $20 range. This may take few days or few weeks or few months, but just give it a time frame of 1 to 3 months, alright? And to get in, you must plan your entries well. A probable entry will be when it comes to retest at this 200 EMA line. So you just have to wait for it to come back to retest this 200 EMA and watch how it moves. Remember, patience is key. The next one is UVXY, the ProShares Ultra VIX Short-Term Futures ETF. UVXY is a leveraged ETF, meaning it uses borrowings or financial derivatives to boost the performance of the assets or index it follows. So it tracks the VIX, which is the volatility index, using short-term futures. And this ETF is all about fear. So when market volatility rises, this UVXY tends to rise. And it is perfect for protecting your portfolio during sharp market drops or unexpected news. But just remember that UVXY decays quickly, and so you should only use it for short-term trades, okay? It moves an ample amount in volume daily, and its average daily volume over 30 days is over 15 million. So it really moves large in volume. And this movement is based on the intraday range, which is the average price movement between the high and the lows of the day, and does not include any overnight price grabs. This is one ETF that I have made some good money on. So let's go to the chart and see how it has performed. And as you can see here, the price was dropping when the market was rising, hitting all-time highs. And just in the space of 2 days, when the market was pulling back, it has already increased by over $3, making an increase of more than 24%. But hey, don't just rush to go and buy. Look for a good setup and wait for the perfect entry. And if you want to join my one-on-one coaching, where I share entry and exit signals and levels, you can just click the link in the description. The third one is TSLQ. TSLQ is a 2 times inverse Tesla ETF which tracks Tesla stock. It moves twice as much as Tesla stock, but in the opposite direction. This means that it goes up when Tesla stock drops. And if you're familiar with Tesla stock, you'll know how wild it moves up and down daily. And then you can now imagine TSLQ moving twice as much. This ETF is an easier way to short Tesla without using margin or options. And it is great for traders who are watching Elon's moves or for big pullbacks after Tesla rallies. This ETF has large daily movement and can create large profits for traders, especially since it also has extremely high volume. Its daily average volume within 30 days is 34 million. And its average daily daily movement is 9.46%. Okay, now let's go to the chart again and see how it has performed. You see, TSLQ was trading at $74.77 just a few months back in March 2025, and it took a plunge down to a low of $14.35 in June and rose back up to $19.34. That's already over 22% increase of over $3 change in price. So you can see. So you just have to wait for it to pull back and retest previous supports and confirm signals of a trend continuation to the upside, okay? Number 4 on the list is the beast, SQQQ. SQQQ is a 3 times leveraged ETF that tracks the Nasdaq 100 index, which holds a collection of top 100 tech stocks. It is leveraged, meaning that it will move 3 times as much as the Nasdaq 100 index, QQQ, but in the opposite direction. Okay, so when tech stocks fall, SQQQ moves big. It moves 3 times the daily drop. So if QQQ goes down 1%, this ETF goes up by 3%. SQQQ moves large daily between its low and high and does big volume daily. Its daily average volume within 30 days is 87 million, and its average daily movement is 2.9%, which is a big move for an ETF. It is a great ETF for those who want to short stocks like Apple, Microsoft, Meta, and other tech giants all in one trade. So instead of you picking each stock individually, this ETF gives you exposure to all the top picks, okay? But again, it is not for the faint of heart, so you must use it carefully. So now, again, let's go to the chart and see how it has performed, okay? So you can see it was trading as high as $58.46 just in April and found its way back down to $17.32. And now it has broken above the 200 EMA and it's headed back upwards to $19.77. That's already an increase of over $2 in price already. And it's heading back to this resistance of $20 range, which will be a good profit target depending on your entry. So make sure you have a good entry strategy and follow your rules. A probable entry will be at a retest of this 200 EMA line here. So watch out for it, guys, so you don't miss out on a good entry, okay? But don't forget, it can multiply losses quickly and you do not hold it long term, okay? And the fifth one is SH. Now, if you want something more stable, this is the one ETF to look at. SH, the ProShares Short S&P 500, is an inverse ETF that tracks the S&P 500 index, but it moves in the opposite direction of the S&P 500 index, which is the SPX. The S&P 500 index is a collection of 500 of the largest companies. So when it goes down, SH goes up. And likewise, when SPX goes up, SH goes down. This is an ideal ETF to have when volatility is increasing, and it is perfect for traders who are looking for a safer inverse play. That is one without any leverage. It also does large volume daily, and its average volume is around 5 million daily, and moves between its daily low and high at an average of about 0.78% every day. So it is a great ETF for hedging your portfolio, especially when the market starts to wobble. So if you're holding positions for long term, no flash, just simple protection. And since it does not use any leverage, it has less risk. And now is a good time to buy this ETF since the S&P 500 recently hit all-time highs and now showing signs of a potential pullback. And also, recent macro data suggests the bullish trend may slow or correct soon. But hey, remember, SH is only for short-term trades and not suitable for long-term holding. And it does not give big returns like the leveraged ETFs. And because the S&P 500 remains in a long-term uptrend overall, any bearish trades must be tightly managed, right? Now let's go to the chart and see how it has done. So you see, SH was trading at a high of $41.69 in June and fell by over 7% to a low of $38.48. And this is the same time the S&P 500 index was rising to its all-time high. And now when the market was pulling back, You can see it rose by 3.4% from its low of $38.48 to a high of $39.82. And already that is over $1 rise in price already. So you see, the good thing about buying ETFs is that you can day trade or swing trade them if you wish. And because ETFs are usually more shielded from price shocks than individual stocks, it makes them a very good option for trading and investing as well. And so these are the 5 powerful ETFs that you can buy when the market is pulling back. So when should you actually buy these ETFs? So you look out for warning signs like when the market is at resistance and it's making lower highs, or overbought signals like RSI, which is the relative strength index, or when momentum is fading. Then you know that buyers are running out and sellers are about to take control, which will drive down the price. Using indicators like RSI and moving averages help to confirm these signals and the market is about to pull back. These ETFs work best when a correction is just beginning and not after the damage is already done. Because by then, these ETFs would have moved up and you would have missed all the moves and end up with just little profits. That is why you have to be on alert and watch closely and have your entry strategy, usually at the break of support. Now, if you're wondering if it's possible to buy from Nigeria, absolutely. You can buy all these ETFs from Nigeria using apps like Trove, Bamboo, or Chaka. And here's how to get started. First of all, you download apps like Trove, Bamboo, or Chaka, sign in and verify your account. Then you fund your account with Naira or dollars. Then go to the search bar and type in the ticker symbol. And then you click on the buy button to initiate your order. And you can buy in with as little as $10. And that's it. It's that easy to get exposure to global ETFs. Now listen, these leveraged ETFs are not beginner friendly. So you must always use stop losses and trade only a small position. 1 to 5% of your portfolio per trade is ideal. So don't go and put all your eggs in one basket. And remember, they're mostly used for short-term strategy, so never hold them for long-term. And for safer hedging of your portfolio, mix with more stable ETFs like SH or bonds or gold ETFs. These are more stable ETFs, but they do not give you that quick high returns, right? Remember, the market doesn't wait, and neither should you. So let me know in the comments below which of these ETFs you're watching right now. Yes, if you already have any of these ETFs on your watch list, let me know in the comments. And don't forget to like this video, subscribe, and share this with someone preparing for the next market move. You can also tap the notification bell so you never miss an update. New trading videos drop every week, okay? And I'll see you in the next video.